For years, everyone believed the same idea. House prices only go up. Banks gave loans to almost anyone. Investors kept pouring in money, and no one thought it could fail. Until 2008, when everything broke. Chapter 1: The Housing Boom. After the dot-com crash in the early 2000s, the U.S. government and Federal Reserve lowered interest rates to stimulate the economy. Borrowing money became cheap. Banks began offering more mortgages. At first, this was normal, but soon, competition between lenders grew intense. Banks wanted more customers, more loans, and more profits, so they lowered their standards. They started giving mortgages to people who normally wouldn't qualify. These were called subprime mortgages. At the time, it didn't seem dangerous. Why? Because home prices were rising. Even if someone couldn't afford their payments later, they could just sell the house at a higher price. Everyone felt safe. Chapter 2: Turning debt into profit. Here's where things get complicated and dangerous. Banks didn't just keep these mortgages. Instead, they bundled thousands of them together into financial products called mortgage-backed securities. These securities were then sold to investors around the world. Even riskier loans were packaged into more complex products called collateralized debt obligations. These promised high returns and were often given high safety ratings by credit agencies. This created a massive chain reaction. Banks made loans, turned them into securities, sold them to investors, used the money to make even more loans. It was like a machine printing money. But there was a problem. The system depended entirely on one thing. People continued to pay their mortgages. Chapter 3: The Bubble Peaks. Between 2004 and 2006, the housing market reached its peak. Subprime mortgages made up a huge portion of all new loans. Millions of Americans were buying homes they couldn't truly afford. At the same time, investors all over the world were buying mortgage-backed securities, believing they were safe. Credit rating agencies gave these risky assets high ratings, which made them look trustworthy. Even when they weren't, everything looked strong on the surface. But underneath, the system was fragile. Chapter 4: The Cracks Begin. Then things started to change. Interest rates began to rise. For homeowners with adjustable rate mortgages, monthly payments suddenly increased. Many could no longer afford them. Defaults began to rise. People stopped paying their loans. Homes started being foreclosed. And then something critical happened. House prices stopped rising and began to fall. This changed everything. Now, homeowners couldn't sell their houses for a profit. Many owed more than their homes were worth. At the same time, mortgage-backed securities began losing value rapidly. What was once considered a safe investment became toxic. Banks and investors around the world started taking massive losses. Chapter 5: The financial system starts breaking. By 2007, major financial institutions were in trouble. Mortgage lenders began going bankrupt, hedge funds collapsed, banks started reporting billions in losses. Because these toxic assets were spread throughout the global financial system, no one knew who was safe and who wasn't. Trust began to disappear. Banks stopped lending to each other. This is known as a credit crunch. And when credit stops, the economy slows down. Chapter 6: The Collapse. The year 2008 was when everything fell apart. Investment bank Bear Stearns was on the verge of collapse. The U.S. government stepped in and helped sell it to J.P. Morgan Chase to prevent a disaster. This was the first major warning. In September, the crisis reached its peak. First, the U.S. government took control of mortgage giants Fannie Mae and Freddie Mac, which held trillions in mortgage debt. Then came the moment that shocked the world. Lehman Brothers collapsed. On September 15, 2008, the 158-year-old investment bank filed for bankruptcy. This triggered panic across global markets. Stocks plunged. Banks stopped trusting each other completely. Investors rushed to pull their money out of financial institutions. The entire system was freezing. Chapter 7: Domino Effect. After Lehman Brothers, the crisis spread rapidly. One of the world's largest insurance companies had to be rescued with an $85 billion government bailout. Washington Mutual, the largest savings bank in the U.S., collapsed. Major banks around the world faced collapse. The global financial system was on the brink. If more institutions failed, it could trigger a complete economic meltdown. Chapter 8: Government Intervention. To stop the collapse, the U.S. government stepped in with massive measures. The most important was the Troubled Asset Relief Program. This program allocated $700 billion to stabilize banks and financial institutions. The Federal Reserve also lowered interest rates to near zero, injected money into the financial system, and supported failing institutions. These actions were controversial. Many people believed the government was bailing out banks instead of helping ordinary citizens. But without intervention, the system might have completely collapsed. Chapter 9. The Real-World Impact. The financial crisis didn't just affect banks, it affected everyone. Millions of Americans lost their homes due to foreclosure. Unemployment skyrocketed. Businesses shut down. The crisis triggered the Great Recession, the worst economic downturn since the Great Depression. Globally, trillions of dollars in wealth disappeared. But why did it happen? Looking back, experts agree the crisis was caused by multiple failures: risky lending practices, complex financial products that few understood, poor regulation and oversight, excessive risk-taking by banks, overconfidence in housing prices. In simple terms, too much risk, not enough control. Chapter 11. Aftermath and changes. After the crisis, governments introduced new regulations. In the U.S., the most important was the Dodd-Frank Act, which aimed to increase oversight of banks, reduce risky behavior, and protect consumers. Banks were required to hold more capital and undergo stress tests. The financial system slowly recovered over the following years. The housing market began to stabilize around 2012. Chapter 12. Lessons learned. The 2008 financial crisis taught several key lessons. Markets are not always rational. Complex financial systems can hide massive risks. Unchecked greed and optimism can create bubbles. When trust disappears, the entire system can collapse. It also showed how interconnected the global economy had become. A housing problem in the U.S. quickly turned into a worldwide crisis. The 2008 financial crisis was not caused by a single event. It was the result of years of risky decisions, blind optimism, and systemic failures. And just like many financial disasters before it, one truth remained: the bigger the bubble, the harder the fall.